there are many scenarios of where the happen might be heading next. Some claim that we are stepping even in a new era of a permanent conflicts and violence, where those perturbations around might be element of our present. So it's very hard to predict, as there are many random situations and many phenomena that may spook the outlook for the daily elements. Those rising tensions between Ukraine and Russia, US-China, China and Taiwan, and many others, bringing more and more concern about the future. Without any further ado, let's get into our episode. Alright, and before we go to tensions and the negative results of deglobalization, I will jump at first to the most important for now elements that has shaken the market recently to the positive side, is that Fed's Chair Powell has stand out and told everyone that Fed is expecting to lower pace of hiking interest rates on its December's meeting. So Fed has already reassuring us that they were expecting this inflation to cool, with jobs market also slowing down. So right now we can find an obvious signs after initial jobless claims that these elements are breaking to some extent. There are still high level of this jobless market, but we are finding that there are some concerns about its right condition, and Fed right now is scared of overreacting, and that their problems may persist for longer if they hike interest rates by that pace. So they want the demand destruction, where those high prices for a certain good will lead to less demand for that good. So that's what we wanted from the beginning of this hiking interest rates process, where this appetite for US dollar reason, where this policy of Fed was very hawkish. Right now, after the most accelerated pace of hiking interest rates in the history, we are backtracking, and that's exactly what is happening, is that the markets has bounced finally. About what drives the markets inflation is, I would like to jump to that slide, is recently the dominant element that's whose factor is a demand. So as we can find, the only one element that Fed can steer is this demand side of inflation. They don't have the power of steering the supply. That's why as this demand started to take a dominant power in its inflationary forming gauges, the Fed started to react, and right now, as demand-driven inflation is overtaking this supply-driven, they are trying to take their foot off the metal. So we can find that due to this chart, due to this bar, chart, by September of 22, ECB found that Eurozone's inflation was mainly supply and energy crisis driven. That's why they are not so keenly on rising interest rates that high right now to not make things worse in the euro area. However, when it comes to US, the attitude of Fed seems to be right in place, with recent more dovish tone as demand-driven inflation has taken out of control a bit recently. So that's what's driving inflation. Let's right now jump to our next very important topic, that you see the global tensions that still have a dominant power in a supply-driven inflation side. So the biggest conflict of 22 was and is still remaining this conflict between Ukraine and Russia. Russia is a key player in the mining of some of resources. Among them there is palladium, platinum, but also is a large exporter of gas and oil. That's why we've seen an energy crisis within Europe, and also that's something that also spreads over other more fragile economies, as Russia has met sanctions from West. We are right now suffering from deglobalization in terms of an ease of flows of different assets. So we are right now going through some shortages that are shifting us to another territories where those supply chains are not yet disrupted. Some of them may get back to Asia and Africa, whereas in Asia we still have the problems with COVID-0 policy that also shutting down factories and also bringing more burden on those elements of supply chains that adds up to this global problems even bigger. So those conflicts entailing problems within also labor shortages and production and importation disruptions that also speeding up this inflationary pressures even more. We also had US-China relations problems where even if you assume that that may become this cheap industry may become a $1 trillion $1 trillion industry by the end of the decade, and right now it's going through hiccups. Many companies already started reducing spending, and this trend is yet to get through 2023. US also taken unprecedented steps to limit the sale of advanced computer chips to China, escalating efforts to contain Beijing's tech and military ambitions. The moves are designed to cut off supplies of critical technology to China that may be used across sectors, including advanced computing and weapons manufacture. So, while a global slump that also impacting the purchasing power of dollar, we can find that we are going through some shocks that may remain for longer, and possibly with conflicts calming down within next year, those problems boiling down to disrupted, distorted supply chains may fade away, but right now we are still far from there. So on the inflation, we still have, on the side of inflation, we still have many questions to get answered. The decision of Fed was recently also driven with this confidence that was waning. US consumer sentiment drops in November and amid inflation right after the similar levels that was post-pandemic breakout. So that's also the one of the factors that add up to their standpoint. Whereas also we are finding out that we are observing a steepest inversion of the 2-10 spread in almost decades. Right now the market is expecting to lower the pace of hiking interest rates. That's why we are finding that more and more investors are flocking the bond market. This pivot is also yet to get correlated with stocks. That's why we can find there is more and more buyers among bond and also stock investors. So is it recession for real or just fake out? Right now we are observing the Fed. Fed is telling us that we might be already through with this very difficult conditions, but what is yet to be reminded that is a still quantitative tightening is the one that may spook the economic outlook for longer. We are going through quantitative tightening throughout 2023, and that's not really nothing to get changed. We are in this contracting period where we may just go through kind of a relief, but afterwards that's nothing from further hiking interest rates, but just with a slower pace. So I wouldn't say the worst is over for the economy. Right now we'll go through the very difficult time throughout 2023 where we have many elements yet to get fixed. So Goldman Sachs Group also thought that we will trade above 4% on bonds through to 2024 as expectations for rate cuts next year are dashed by the economy not entering a recession and inflation remaining high. Alright, let's jump to market outlook, and you get here what JP Morgan expects from the markets. So JP Morgan finds that during first half of 2023 we'll get just to a target on S&P to 4,200. So markets already reacted positively to Fed, but distortions still exists. Fundamentals will likely deteriorate as financial conditions continue to tighten. So for the first time since the pandemic, margins inflected lower than in the third quarter than in the previous ones. That's likely to keep your margins moving in the downward direction, and that ultimately is the source of why you get no earnings growth. That was said one of the analysts, and I also buy that opinion, where I do find that earnings growth will be somewhat extinguished through 2023, as this fiscal policy is still not pushing in favor companies. So that's why there is a relief rally, as there is a highly possible right now that what the market was awaiting for throughout 2022 right now comes to fruition. But don't forget that we are still far from return of optimism on the markets, where those foundations on which the markets are growing are just this squeezed optimism that right now is letting out when we are just rebounding out of this very strong negativity regarding that we will be tightening and also hiking interest rates infinitely. Right now we finding out that it's not a clue, and we just need to some relief before possibly another slide to lower levels. I don't really know whether right now we'll go downward below the recent dips of 3,600, but we'll definitely have many buts when it comes to turning the market for the bull side for good. So let's jump to market movers. Let me switch our windows. Okay, so in terms of market movers, let's find out. We still have today non-farm payrolls yet to be published, and that's what is expected. Also, what is not without significance for the Fed's reaction. That's why if we find out that non-farm payrolls is much better than expected, that may recalibrate Fed's viewpoint on its 0.5 interest rate hike. If the economy will get much more bullish with next data yet to be published, we may also observe that this disproportion between what Fed told during recent meeting and what may get published during 13th of December's speech will be kind of a enlarged. Sorry. Okay. So right now, as we are through with market calendar, we are awaiting next week. I will just make an outlook of what's coming out on Monday. As for the next days, I will let you know on 5th of December. So we will have PMIs for US. That's worth watching. And beside this, next week shouldn't be packed with many events. However, important for the market will be decision of BOC, that is Bank of Canada, where forecast for hiking interest rates is just at a lowering 0.25. That's lower than Fed is considering. If it comes to fruition, we'll have a hiring chance that lower interest rate hike will also get to US. Alright, so let's get to another element. That's a trade idea. So in terms of trade idea, we will have some of the charts to talk over. At first, let's have a look at, let me jump to another window. At first, we have a DXY that is sliding downward through 105 that means that we are still in a sell-off mode that is putting many indexes in favor of growth. In terms of the most important for today chart will be, in my opinion, XAG. That's still, if you haven't taken advantage of our previous proposition of a trade, that was to take position within the triangle right at 21.3, you might right now watch out for the opportunity of catching up this trend. So right now silver to US dollar is trending above the recent highs and is relentlessly heading towards next objective, that is at 24.36. It's around 7.78% from here, and I do expect silver to rebound out of these highs, so backtrack to the levels of 22.0 to take a downward move of around 2.5 to 3% level next week, and afterwards, if this floor will be achieved, I would expect this trend to continue. So I do expect from silver something like such a move, and then move directly towards our 24.25. So why do I expect this to happen that quickly? As on 13th of December we have a Fed meeting, that's why the market should be pushed on that hopes of lowering pace of hiking interest rates. So I do expect the market to behave in a bullish mode within next 2 weeks, and on the Fed meeting, when those 0.5 will get delivered, we will see some of a sell-off, at least in a short-term period. So by then I do expect that within those 8 to 10 days the silver should increase in its valuation. In terms of trading board, I would assume this one to behave like this. So if the silver will drop below this and this highs of 23rd of November, I wouldn't expect this proposition to get valid anymore. But if we jump down to 22, I will jump onto the silver US dollar bandwagon and ride the wave forward. So silver US dollar is the trade that gives you this risk reward ratio of 3.9. That's highly decent in terms of trading area, and what may bring you a nice profit. Remember about risk management, remember about taking stop losses, and not putting everything on the table. Just scale your portfolio for such risky moves. I do expect the silver to behave in that scenario, but you maybe get ready for also kind of a distortions in terms of the volatility that may also turn up out of nowhere. So for me, that's it in today's episode. Thank you very much for watching. Sorry for lower audio quality this time, but we are I picked up a bag and right now need to record at home, but on Monday we will be back with our online episodes with chats and everything tuned on. That's why I do invite you for Monday's episode 8:45 East time every single day. Thank you and bye bye.